So this webinar would be divided into typically 3 sessions. First would be, we will be dealing with the customs provisions, thereafter with the GST provisions, and further thereafter with the direct tax proposals. So I hand over the platform to Rajat Doshi, who will be the speaker for the customs portion. Over to you, Rajat.
Thank you, Shweta. So, firstly, I'll take the customs law changes and then I'll move on to changes made in the CST Act. In customs law, two important legislative changes have been incorporated. Firstly, they've introduced proviso to Section 25(4)(a) to the Customs Act. Now, this Section 25(4)(a), many of you will remember 2 years back in Union Budget 2021, they had introduced this new provision, Section 25(4)(a), in which they had provided an expiry period of 2 years in respect of all conditional exemption notifications, meaning they had said that all conditional exemption notifications will expire automatically after a period of 2 years unless they are extended further by issuance of another notification to that effect. Now, at that point of time also, there was a little apprehension in the minds of trade and industry that what will happen as far as notifications such as FTA notifications, notifications issued under the FTP, what will happen? Whether those will also expire automatically after a period of 2 years, or there are any exceptions to this. Now, in this year's budget, they have basically, by addition of this proviso, they have added exceptions. They have added certain conditional exemption notifications in respect of which this period of 2 years will not be applicable, meaning thereby that these exceptional conditional exemption notifications will continue to be applicable and there is no need for revival of these notifications after every 2 years. In this list of exceptions, one of the exceptions is FTA notifications, any and all type of FTA notifications, ASEAN, SAFTA, or any type of FTA notifications. There is no need for renewal after every 2 years. They will be applicable unless and until they are rescinded by issuance of another notification to that effect. Also, we have notifications issued in respect of foreign trade policies, such as the Advance Authorization Scheme notification, EPCG, road tax scheme notifications. Also, temporary imports such as job work, repair, imports into India, re-import, and certain other types of exemption, conditional exemption notification on which this 2-year expiry period will not be applicable. Apart from this, one more important change which has been done in this year's budget is that they have increased the expiry period for a number of notifications. So right now, one exercise which many of the importers should do immediately is to see that what all benefit, conditional notification benefit they were availing and whether those exemption notifications, the validity has been extended or not. And in case those have expired and there is no notification extending their validity, they should immediately file a representation bringing this to the notice of the board and the central government that maybe the send notification has skipped and there is a requirement of trade and industry that such a notification be made applicable once again and the validity period be increased. Another important change which has been made in the Customs Act is in the settlement provisions. Now they have introduced a time limit of 9 months within which all proceedings before the Settlement Commission should conclude. So if today I file an application, then within 9 months, which can further be extended to another 3 months, the settlement proceedings should conclude. If the settlement proceedings are not concluded within the set time frame, then the proceedings before the Settlement Commission will close, they will abate, they will lapse, and the matter will again be referred back to the adjudicating authority for him to adjudicate on the show cause notice. So effectively, if the matter is not concluded within this time frame, the opportunity to get the matter settled and avail the benefit of settlement provisions such as reduced penalty or no prosecution being initiated, that sort of an opportunity will go away. and there is no provision which allows us to refile the application. So for instance, I file an application in respect of a show cause notice, and for any reason, due to a fault of mine or department's fault or settlement commission's delay, the matter does not conclude within the 9-month time frame, and the matter is reverted back to the adjudicating authority. There is no provisions which allows me to file it once again with the settlement commission. So this window has to be kept in mind going forward. Plus, one more important and crucial aspect, for existing applications, pending applications also, they've said that this 9 months time period will be applicable, and it will start from the date on which the finance bill is passed. Excuse me. So it is relevant for all the assessees whose settlement applications are pending before the commission as of this moment, that they should make all possible endeavors by filing early hearing applications and all to get the matter settled as quickly as possible within this 9-month time frame. And also it is important for all the assessees who are going to file who are in the process of filing a settlement application, because they should ensure that the entire proceedings get concluded within a 9-month time frame. Now, also to clarify one more aspect, this 9-month time period will start from the end of the month in which the application has been filed. So if I file sometime in the month of January, the 9-month period will start from the end of January. That is basically from February onwards, they'll start counting the 9 months time period. So this is something which is very important and crucial and to be kept a note of. Then let us have a look at the changes in the Customs Tariff Act. Now, several rate changes have been made. We will not be discussing all the rate changes. For that, I would request you to kindly have a look at the detailed update which we had shared 2 days back on the day the budget was introduced in the parliament, in which we have discussed in detail all the rate changes. I think that it will be more prudent if you have a look, and in case you have any concerns or if you need any clarifications in that, you can ask questions regarding that. You can also drop an email to us. Now, apart from rate changes, there are two very important changes in the first schedule to the Custom Tariff Act, which I would want to highlight. First is that they have amended entry 9801, which is basically the project import scheme, which allows import of entire plant, all the plant and machinery, all the capital goods required for setting up of a new unit or substantial expansion of a new existing unit. They have amended this entry, and now they have sought to discontinue the benefit of project import scheme in respect of solar power plant or solar power projects. So going ahead, in 9801, under the project import scheme, the benefit will not be available in respect of solar power plant, solar power projects. Now, one thing I would like to bring to your notice, one very crucial aspect, is that this entry or this amendment will come into effect from will come into effect from the day the finance bill is passed. So you still have time for another 1.5 months till the time this finance bill is passed by the parliament. So if your contract for import of goods required for setting up of solar power plant or project has already been registered with the customs, but you are yet to make imports, I would advise that you start making imports and try to complete it as quickly as possible, especially before the passing of the finance bill. Because once the finance bill is passed, then even though your contract may have been registered under the project import scheme for import or for setting up solar power plant or project, but still the benefit will not be allowed to you. So this is one thing to be kept in mind. Another important change which they made is they have introduced several new tariff items. You can see a list of all the chapters in which new tariff items have been introduced. All these new tariff items will be applicable with effect from 1st May 2023. So I would request all of you, all the importers, all the assessees who are dealing with all these chapters which are there before you, just have a look at the new entries, because there is a possibility that the product in which you are dealing with has undergone a change in classification on account of introduction of these new tariff items. So just have a look at the new entries just to rule out the possibility that on account of this change, there is a change in classification of the product which you are dealing with. But this, again, like I said, will be applicable with effect from 1st May 2023. You still have time to do that exercise and be sure about the fact that on account of these new tariff items, there is no change in classification of your particular product. Now, we'll have a look at the changes made in the Central Sales Tax Act, CST Act. One very important and key change which they've made this year is they've made certain changes in section 19 of the CST Act. In this, basically what they've done is they have replaced the existing Central Sales Tax Appellate Authority with the existing CSTAT. CSTAT right now deals with all the matters relating to customs and erstwhile service tax and excise law. So going ahead, all these CST matters will also lie before the CSTAT. All the appeals under the CST Act will also lie before CSTAT. Secondly, as far as the matters which are pending as on date before the appellate authority, CST appellate authority, they have said that once the finance bill is passed, all these pending matters will get referred to the CSTAT, and all the hearing and all the arguments will take before the CSTAT, and the order will also be issued by the CSTAT only in these matters. So kindly keep a note of this, that going ahead, if you have to file any appeal under the CST Act, that has to be filed before the CSTAT. And if you have any pending matters as on today, all those pending matters will be heard and taken up, and order will be issued by CSTAT. Second important change which they've made is they've abolished the advance ruling authority which was there under the CST Act. So now under the CST Act, there is no mechanism to obtain any advance ruling. As far as pending matters are concerned, matters which are pending as on today before the advance ruling authority, for that also they have incorporated a provision to provide that all such pending matters will also get referred to CSTAT, and CSTAT will issue a ruling in this regard. So it is only in context of pending matters, no new matters can be filed, and right now there is no advance ruling authority. Then we have changes in the GST law, which Shweta will take over.
Thank you, Rajat. Now I will be sharing my screen with respect to the GST matters. Just a second. I hope my screen is visible to everyone.
Yes, Shweta, it's visible.
Okay. So as you all know, just a minute. Yes. So we will be going through the provisions, the changes which have been proposed in the in the GST Act itself. And though these changes are typically to align with various proposals that had been made during the 47th and 48th GST Council meetings. Some of them are those and some of them may be new as well. So for them to take place through the enabling provisions, the changes are required to be made in the Act, and therefore the changes have been proposed in the CGST Act. The first change which comes up is the scope for opting composition scheme widened. So in this case, the section 10.2 and section 10.2a that has been proposed to be amended to allow the composition taxpayers to make intrastate supplies of goods. So through e-commerce operators. So as of now, what was happening was that through e-commerce operators, the people who have opted for the composition scheme, they were not allowed to make sales through the e-commerce operators. So to enable them to make sales to the e-commerce operators, this provision has been brought in. Just a second. Yes. However, we need to note that the restriction that continues with respect to the unregistered suppliers now also, and restriction on suppliers of services, that also continues. If we remember somewhere, I think in 47th or 48th GST Council meeting, they had proposed for unregistered suppliers also, but we do not see that provision coming up in the proposal which has been made in the union budget. There's an important change which has been made in section 16, which pertains to the ITC reversal on non-payment within 180 days. We all were aware that there was a provision in section 16 proviso which stated that if a supplier, if a buyer typically does not pay to his vendor within 180 days, then there was a provision which stated that I've highlighted that thing in red, that it shall be added to his output tax liability along with interest thereon. Meaning thereby, if a buyer has paid, if a buyer has not paid the amounts means the tax amount plus the assessable value amount, if he has not paid that amount to his vendor, then in that case, the provision which was there was typically that it shall be added to his output tax liability along with the interest thereon. However, in such manner as may be prescribed. However, typically speaking, there was no such manner which is aligned with the system which is existing today. So the system which was prescribed in the rules was pertaining to the old method which was prescribed in the GST law, which talked about the GSTR 1, 2, 3, which never came into existence. So it was in that context. Law was never changed to provide for as to what will be the actual mechanism for adding to his output liability along with interest thereon. So in principle, in practical, what the assessees were doing is they were typically reversing the credit on the on the credit portion, on the GST portion, along with interest if they're not making the payment within 180 days, and thereafter they re-availed that credit. However, typically speaking, there was no mechanism in law which actually allowed them to do so. So now this provision has been changed, and instead of added to his output liability along with interest thereon, it has been substituted with paid by him along with interest payable under Section 50, which is typically what the assessees have been doing now or earlier also from the time when GST took place, from the time when GST is in force. In fact, I would like to point out here that to this effect, even notification number 19 by 2022 was issued, dated 28/9/2022, which was effective from 1st of October 2022, wherein it provided for the assessee to reverse the amount along with interest out of the ITC. A very interesting provision here to note is that there have been, see, if we typically interpret the law, there is a statute in which there is Section 16 that prescribes a mechanism, that provides a law that needs to be followed, and it also says that it has to be in such manner as may be prescribed, and there was no manner which is in force typically. So if for the past period we see, because all these changes are prospective, so if for the past period we see, then in that case one can always argue that there was even though there was an enabling provision for this kind of an activity, but there were no machinery provisions which allowed him to do so. There was no mechanism in which he had to do. So there are plethora of cases and settled common law that if there is a provision which asks me to do something, but there is no mechanism specified by the government, so in that case, typically that particular provision itself cannot be enforced. So for the past period, in fact, if there are any litigations pending with the department, then in that case, even the person can argue that since there was no machinery provision to enforce this particular provision, therefore, how can I make a payment in this regard? How can I add my output tax liability along with interest thereon? So what I try to say is that there is something called enabling provision, there is something called machinery provision, and then there is an implementation on the portal for that. So what's happening in GST regime is typically most of the time we see first they will make the change on the portal, then they make changes in the rules, and thereafter they come with the changes in the statute. However, in actual, it should always be something like first there is an enabling provision, then there should be a mechanism which is prescribed for enforcing that enabling provision, and then how it is to be implemented, that needs to be seen on the portal. But this is how our system is working till now. In fact, we jokingly at many times say that there are two laws in GST. One is the one which is written in the books, and the other is the one which is there on the portal. Because at many places we have seen, first of all, the change gets implemented on the portal itself, which does not flow from any provision of the law. And subsequently, there are changes being made in the either the rules or the act. So this is one such typical examples, I would say. So to merely say that this is just realigning or realigning with the rule made may not be really correct up to some extent. Reason being, though it is definitely a realigning, but if for the past periods the things are there, then definitely those can be argued in such a manner. And there are not one but plethora of cases which support these kind of arguments. Now, after the changes are enforced, then after that, the assessee will be required to reverse the credit in table 4B of the GSTR 3B. Thereafter, whenever he makes the payment, he can re-avail that credit. And after that, corresponding disclosure method was also prescribed in notification number 19/2022. For that, one can refer to that notification. So this one is really, really very interesting provision, because all the changes had taken place in the reverse manner. Then there are important changes made in the blocked input tax credit under section 17. One important change that has been brought is that ITC has been restricted for supply of warehoused goods before home consumption. We all know that in Schedule 3, there are 3 items, which is paragraph 7, 8A and 8B, which were later introduced somewhere in January 2019, I guess. Yes, January 2019. So those 3 provisions provided for, like 7 provided for typically the mercantile trading, wherein the if the person sitting here in India buys goods from one country and sells in another country, goods are not even entering the country, goods are not even moving out of the country. So in that case, that particular supplies, they have to be not to be treated as supply as per Schedule 3, and therefore there will be no GST implication. Similarly, there was provision in paragraph 8A of Schedule 3, which prescribed that if you import the goods in a bonded warehouse and the goods are kept there and goods are sold in the bonded warehouse to any other person in the country before the home consumption takes place, then in that case, that will not be treated as supply of goods, and typically no GST applies on that. Similarly, there was para 8B, which talked about high C sales. We all are very well aware of the concept of high C sales. So if the goods are sold on high C sales, then it says that it is to be treated as not as a GST supply, and therefore GST was not required to be paid on that. So why I mentioned all these 3 is typically the requirement for reversal has come only for 8A, which is sale from the bonded warehouse for home consumption. It is not applicable for mercantile trading, not applicable for high C sale. Even though the logic for all the 3 for not levying GST is typically the same, but somehow they have typically said that, okay, that is not a sale. We will not, that is not a supply. We will not treat it as a supply. We will not levy GST on that, but that needs to be treated as exempt supply in terms of section 17(3), and therefore the ITC reversal will be required on that. So if suppose I am an importer, I import goods, I keep them in the bonded warehouse, I incur many expenses there, and thereafter there is a customer of mine in India only, and he asks me, I sell those goods to him in bonded warehouse only, but I incur all the expenses for the clearance also, because this is the normal scenario. Normally the buyers ask for all the clearances and everything. They say, we don't know, you have to just provide us the goods. So they incur all the expenses for the clearance also, the custom clearance also, for the logistic also, and everything. So in that case, as per this section, it says that the ITC will have to be restricted. ITC will not be given for such particular kind of transaction, because it will be treated as an exempt sale. Not only the direct ITC, but also reversal will call for the common ITC also. One will have to bifurcate its supplies into exempt and taxable, and accordingly the common ITC will also have to be reversed. For this, I think it's not a blanket provision. It says for the transactions as may be prescribed. So in this case, I assume that it may not be the case, because otherwise it will have, there are many players in the market which typically undertake these kind of transactions. So I don't think so that this will be any kind of a blanket provision for all kind of transactions taking place in the bonded warehouse. I presume that there would be certain specified kind of transactions wherein only the reversal would be required, and not for all kind of goods or any kind of goods stored in the bonded warehouse. Why I'm saying so is because in the 48th GST Council meeting, they had indicated this kind of thing towards the duty-free shops and all. So duty-free shop is also one kind of a bonded warehouse only. So with respect to that, in the GST Council meeting, it was indicated that the credit with respect to that will have to be reversed. So I think the notified transactions, maybe of the duty-free shops, or maybe some more added to that, but it may not be really a blanket provision to cover any kind of supplies in the bonded warehouse, wherein the sales are taking place before the home consumption. ITC restricted on goods and services in relation to the CSR activities. We all know that this is a huge litigative area, and there are many AARs on this, and there are contradicting AARs. So some say no, the reversal has to be done. Some say no, the reversal is not required to be done. As Section 135 of the Companies Act, that mandates the companies to do the CSR in case the threshold turnover requirements are met. So it is typically some kind of a mandatory requirement which is flowing from the law. In fact, if we see Section 17(5), directly, if we say there was no provision which was required to reverse the credit which has been taken on the CSR activities by the companies. However, there were interpretations like whether can we say that it is some kind of a free gift, because there is a restriction in the in Section 17(5) with respect to the fact that if the assessee makes any free gifts, then in that case the corresponding ITC needs to be reversed by the assessee. So I mean to say, whether really some courts have, some ARs have interpreted it to the extent that yes, this is a kind of a free gift, and so therefore that gets covered by that clause, and hence the credit needs to be restricted on this. However, one argument is always this, that gift means typically which is something voluntary. CSR is never voluntary; it is mandated by the law. So there are decisions which also state that the CSR, the credit should be allowed on the CSR activities. However, not to put to rest at rest that controversy, this provision is being brought in, which clearly will be typically by way of insertion of clause FA to Section 17(5), which will say that there will the credit in respect of CSR activities shall be restricted. However, again to say that this is a prospective provision. As of now, it is not a retrospective provision. So for the past periods, one can always have an argument, if the matters are going on, that this kind of provision was not there before this particular amendment was made. So hence, at that point in time, all kind of arguments like for whether for gift, whether for personal consumption, whether mandated by law, so all these kind of arguments could possibly be taken, and maybe with a good amount of with a good order also, a person can contest the case. So because this is a prospective provision, not a retrospective provision. Next is clarity provided on exemption from registration. So we know that there were two sections, Section 22 and Section 24. Section 22 that provided for where the registration is not required. Section 24 provided where mandatory registration is required. So as of now, Section 24 was a non-obstante clause, which was notwithstanding, but it was notwithstanding anything contained in section. That was notwithstanding anything contained in Section 22. I mistakenly said that 22 is not required. It's 23 which is not required. So in Section 23, it says that any person who is engaged in the business of exclusively supplying of exempt goods or services, then in that case the registration is not required. But since it was not a non-obstante clause, as against that, in Section 24, where there was a list of the assessees which would be required to have mandatory registration, there are certain items like if a person who is liable to pay under reverse charge, then in that case, the mandatory registration was required. So there was always a conflict. Like say, I am a person who is providing the exempt supply of goods or the services. So in that case, I'm saying that I'm covered under Section 23. However, under Section 24, as per Section 24, if I am availing, say, some lawyers' services or some GTA services which are subject to the reverse charge, then in that case, whether I'm required to take a registration. So one section provided me that I'm not required to take registration. The other said I'm required to take registration. And none of these sections had any overriding effect. So now this clarity has been brought in that notwithstanding anything contained in Section 22 or 24, means Section 23 has been given the priority. So even if you are covered in Section 24, like for the reverse charge, whether for the rental dispute that had rental of residential property, that the dispute which had recently arisen, or for the reverse charge services, or for any other thing which is covered in Section 24. So if you are required to mandatorily get yourself registered, but your particular outward supplies are exempt, then in that case, you're not required to take any registration. One very funny aspect I would like to point out here is so in this manner, typically, are we saying that the government is foregoing a lot of revenue in this? Reason being, if I am a person who is required, who's providing exempt services, before this provision would have been implemented, normally the people used to take registration under Section 23, under Section 24, and discharge their liability under discharge their liability under reverse charge mechanism. And accordingly, since they were providing their outward services as exempt, so they were not allowed to take the credit. So that was typically a net revenue of the government. But here, by giving this kind of a retrospective overriding effect to Section 23, in such a case, there might be a lot of revenue loss to the government also in this. Moreover, there is also another funny fact is that if we see Section 9(3), which is typically the enabling provision for the reverse charge mechanism. So in that case, it creates a levy. Say, for example, I am an advocate and I provide my services to business houses. In that case, there is a levy created in terms of Section 9(3), which has a corresponding notification also, which provides that the recipient of services will be liable to pay tax. So levy is created that their recipient will be liable to pay tax. But now if we see, and earlier what was happening is that people were taking registrations also, and they were paying the tax also, assuming that the recipient is an exempt supplier of goods or services. But now what will happen is typically neither I am paying the tax because my services are subject to reverse charge. I'm not required to take the registration at all, nor the recipient is taking the registration. So how will that levy be typically affected? So that is really not clear. So how will that be interpreted needs to be tested in the courts of law. We'll move to the next slide now. Just a second. Just a second. Yes. Yes. So there is a time limit of 3 years, which has been prescribed to furnishing details in GSTR 1, 3B, 9, 3B, 8, 9, and so on and so forth. So as of now, so this provision typically provides that there shall be a time limit of 3 years, and the SSC cannot be left open to furnish the returns in eternity as and when he wants. But really, I feel that this provision really needs to be tested in the courts of law. Reason being, because we currently also have the provisions which state that after 6 months of non-filing, the registration shall be cancelled. So once it is cancelled, in any case, the SSC cannot file the returns. Even if we assume that the person would be typically going into the courts for revocation of the registration also, and his registration also gets revoked. So even then, how this would be interpreted as to whether the courts will allow the period of revocation to be not counted for the purposes of filing of the returns, how these will be interpreted by the courts, that we need to see, especially because even if the time period is very long during which the revocation took place, still if a person has not filed for 5 years or 4 years, so are we saying here that even the courts can allow a maximum period of 3 years, excluding the period of revocation also? So how this will be typically implemented, and how this will be interpreted also, that we need to see, because why this time limit of 3 years specifically has been brought in, when we already have a provision of that after 6 months he cannot his registration would be cancelled. If his person is not regularly filing for 6 months, then after 6 months his registration would be cancelled. So this really needs to be tested in the courts of law. Enabling provision to compute delay. Section 56 is being amended so as to provide for an enabling provision to prescribe the manner of computation of period of delay for calculation of interest on delayed refunds. So even now we have the department, if the department is delaying in providing the refunds, so in that case, as of now, we do have the provisions, but we really do not have the mechanism as to how that will be calculated, from when it will be calculated, up to what time it will be calculated, and what will be the mechanism followed by the department to grant the interest on the refunds. Though it's very, for the refund, department gives, if department gives principle, that is a boon in itself. One has to really fight with the department to get the interest. But this provision states that there will be a prescribed manner in which the department will have to give the refunds, the interest on the refunds, how that delay needs to be computed. So for that, then there will be notification for the same, which would be issued once the proposal to amend is accepted. All these provisions as of now, they would all be prospective from the date, prospectively implemented from the date when it receives the assent. Penal provisions for e-commerce operators. There are certain penal provisions incorporated in the Act specifically for e-commerce operators. We all know that the unregistered person, he typically cannot make an interstate supply. Secondly, we also know that an unregistered person, he cannot register himself on the e-commerce portal to sell his goods through the e-commerce. But through this provision, through this provision, the liability has been cast on the e-commerce operator himself to ensure that he follows certain guidelines, so as to ensure that none of the unregistered person gets to make a sale through his portal. Or so there are 3 situations which have been prescribed where the liability has been cast on the e-commerce operator himself. Though we are not saying that separately there can be no penalty or no action against that particular person who is unregistered person, or who cannot otherwise make a supply through the e-commerce portal. Separate action may be taken against him, but here the action is on the e-commerce operator. So it says that a penalty amounting to rupees 10,000 or an amount equivalent to the amount of tax involved had such supply been made by a registered person has been proposed on the following offenses. So this is a very big liability. It's not only, there's no maximum cap. So if there is by mistake any unregistered person, say he has registered himself on Amazon portal, and from there he is making the sales. So in that case, whatever sales he is making and whatever would be the tax on those particular sales, so the entire thing can be demanded from the e-commerce operator in the form of penalty. The offenses which are prescribed is that he allows a supply of goods or services or both through it by an unregistered person other than a person exempted from registration by a notification. So an unregistered person, he cannot make a sales through the e-commerce operator. But if there is an exempted person who is specifically exempted by notification under this act, so in that case, he can exempted means exempted from registration. So he can typically sell the goods through e-commerce operator. But if it is otherwise, then the e-commerce operator would be liable. Second is he allows an interstate supply of goods or services or both through it by a person who is not eligible to make interstate supply. So if there's any person who is not allowed to make interstate supply, in that case, this particular e-commerce operator again would be liable to penalty. Fails to furnish the correct details in the statement to be furnished under subsection 4 of section 52 for any outward supply of goods effected through it. And then if he fails to furnish the details with respect to section 52 is under subsection 4 of section 52. So in that case, then in that case, the penalty would be applicable on him. This is specifically for the e-commerce operator. As was proposed in the 48th GST Council meeting also, that there would be certain offenses which would be decriminalized. So these are the steps which has been taken by the government to decriminalize the offenses. Following the recommendations of the GST Council meeting, the amendment has been made in section 132 and 138 to decriminalize 3 kinds of offenses under GST. One is the obstruction or preventing any GS officer in discharge of his duties, deliberate tampering of material evidence, failure to supply the information. So earlier, these 3 activities were typically in the list of the prosecution, where the prosecution could be initiated against the person who is involved in all these 3 activities. Now, these 3 activities has been removed from this section and therefore decriminalized. When we say decriminalized, typically the prosecution provisions will not be made applicable on these particular kind of scenarios. Further, with respect to the compounding of offense, to reduce the compounding amount from current range of 50 to 150% to the range of 25 to 100%. So this is a rarely used provision because normally people normally don't go into the compounding, but this is reading both these provisions. This is typically a very, very welcome step by the government, because welcome step by the industry, because if a person wants to compound the offense which he has done under the GST law, then in that case, the compounding amount itself was kept as very high, which ranged from 50% to 150%, which could be anything between this range depending upon the gravity of the offense. So now this has been rationalized to 25% to 100%. So these are the steps taken by the government for decriminalization and compounding of certain offenses. The reason behind this decriminalization and compounding is typically because many a times it had been observed that the government officers were taking undue advantage of these provisions, specifically these 3 kind of offenses which are prescribed, because these are something like failure to supply the information or deliberate tampering of material evidence. To prove them was really, really very difficult. So the government officers were actually taking very undue advantage of this, and therefore now the government has proposed to decriminalize these offense. They will keep them out, and now the department officers cannot take a resort to these provisions and say that we will arrest, we will do this, we will do that. Now, at least as far as these three offenses are concerned, they cannot initiate the prosecution for them. Just a second. Data sharing with other systems. This is more towards this is more from the department's angle rather than from the assessee's angle, which prescribes that a new section 158A would be inserted, and how and in what manner the information would be shared between various systems, between various departments, like between the GST and income tax, or between GST and customs, or between GST and any other department. So if there are, so it will prescribe the mechanism. Section is there. Apart from that, definitely they will prescribe the mechanism through rules also. They might come out with some notifications also, which will prescribe the mechanism. However, as far as the assessees are concerned, this is more to do with the department's side. This is important. Retrospective effect to paras 7 and 8 of the Schedule 3 of the CGST Act. So, as in my initial slide, I had already mentioned that there are three specific provisions in Schedule 3, which are almost on the same footing as far as the reasoning is concerned behind them, for not to treat them as supply, which is para 7, which talks about mercantile trade, para 8A, which talks about warehoused goods, supply or sale of warehoused goods, para 8B, which talks about the high sea sales. So in Schedule 3, these three provisions provided that these shall not be treated as supply in itself. But these provisions were inserted from 31st of January 2019. In fact, they became effective from 1st of February 2019. So, for the period prior to 1st of February 2019, that is till 31st of January 2019, these provisions were not there. Basis the old practices, basis the logics given and interpretations in the GST law, these kind of transactions were treated differently by different assessees. So as to align, so thereafter this proposal was made to amend the Schedule 3, and it was amended, but at that time it was amended prospectively. So now it has been clarified, the amendment has been made, which says that the amendment will be retrospective from 1st of July to 2017, meaning thereby that from 1st of July 2017 itself, these kind of transactions will not be treated as the supply. A saving clause is also provided that no refund of the tax already paid on such transactions will be allowed for the period. So before that, as I mentioned, that before that, since this provision itself was not there, so I'll just take a few minutes to explain this kind of transaction and as to why, what kind of problems could be faced now also. So before 1st of February 2019, these provisions were not there. Depending upon different interpretations prevailing in the industry and with the consultants, there were certain assessees who were treating these supplies as exempt and accordingly making a reversal of the credits. There were certain, even though there was no mention in the act per se for these kind of activities, but basis different kind of interpretations. Like if I talk about, say, mercantile trading, which is typically sale from one country to another sitting here in India, then in that case, the plea was always that sale has not happened here in India itself. So the place of supply is outside India. So in that case, it cannot be subject to tax here in India. So they were treating it as exempt. There was another set of assessees who were treating it as export of services also. There were another set who were saying no, nothing doing, because there is no specific exemption in the law for these kind of transactions. Therefore, we will pay tax. So this saving clause is typically for those people who have already paid tax, and it says that just merely because 1st July has been prescribed as the effective date, which is a retrospective date, it cannot be said that you come and claim the refund from the government. So this is the saving clause. However, again, having said that, the same has been proposed to settle the issue with respect to the litigations pending for the past period when clause 7 and 8 were not there in schedule 2, wherein the departments had raised the demands pertaining to that period. So still, as of now, we have seen that even for our clients, that there are demands which are for that period, whether for the outward tax liability or for the exempt or for the services, the supply of goods or services to be treated as exempt and accordingly the reversal. So there were litigations going on. Now this particular provision will provide rest to this kind of controversy. Now, another important change which has been made in the definition of OIDAR and also non-taxable online recipient in terms of the IGST Act. So the new definition for the OIDAR, this definition is introduced to provide the taxability of OIDAR service provided by any person located in non-taxable territory to an unregistered person receiving the said services and located in taxable territory. So now it has been simplified. It simply says that OIDAR is typically online information and database access and retrieval services. So if the supplier of the services of online information and database access retrieval services is located outside India and the recipient is here located in India, then there was a complex definition which was provided earlier, wherein and provided the situations where the recipient is to be treated as non-taxable online recipient. So in that case, since it was very cumbersome language, which was typically like, it should not have been used for his furtherance of business or something like that. So my clear short here point is that obviously a person who is selling the services, he can never assess whether the recipient would typically be using those services for his furtherance of business or not for furtherance of business, whether they are for his personal consumption. He cannot estimate that. So what was happening is that if he is providing these services to non-taxable online recipient, then he was required to appoint an agent in India who would discharge the tax liability on those kind of services. So there were a lot of litigations going on around this issue, because the OIDAR service provider often takes the plea that I cannot determine, I have no means to determine whether the recipient of my service would be using those services for his personal use or for his business use, because there can be many. When I say online information and database access retrieval services, it typically means, if I'm downloading some kind of database from a server which is located outside India on paid basis, if I am downloading some kind of videos from a service provider who is located outside India, and from his server I'm downloading certain material for a payment. There are so many websites today, so many in this era of internet. We download so many things by making a payment also, which are necessary to us. So in that case, the definition has now been made simple for the OIDAR person to simply see if the recipient is providing him a GST registration, then in that case, for him, he is a taxable person. If he is not providing a registration, that is typically the recipient is an unregistered person. Then in that case, that particular supply would be non-tax. That particular recipient would be treated as non-taxable online recipient, and therefore this simplifies the tax compliance for the OIDAR service provider. So this was very much essential, because actually this issue was a very big issue as far as the service providers were concerned. Second is the definition has been amended for the OIDAR services, and it has been amended to remove the condition of the service being essentially automated and involves minimal human intervention. This is very, very important, because if earlier there was this condition typically in the OIDAR definition that those services should be essentially automated and should involve minimal human intervention. So in that case, there always used to be dispute between the department and the assessee to say whether there are essentially automated condition, whether the services are essentially automated and involves human intervention or not, because there are so many services. Like suppose if I want to, see, I want to download I want to avail some kind of services for some particular typical technical training from a service provider who is located outside India. And he has his online videos made for that, and subject to my payment, he will provide me that coaching services, you may say, or those videos, you may say. So the service providers used to argue that this is not service which is essentially automated and involves minimal human intervention, because those videos are typically made by the human beings only. So unless and until they come and coach you, then or they come and provide the training to you, so that is not something which is which can be done without human intervention. It requires, in fact, a substantial amount of human intervention. So those kind of grounds were being taken, and definitely the courts also do not have so much of the technical expertise to determine whether it's essentially automated and involves minimal human intervention. I've just given a very, very layman example. As far as the tech industry is concerned, there can be many, many examples for that. So now this has been these conditions have been removed. So now if it is proved that the service is mediated through IT, and it is impossible to perform in the absence of IT, then the same can be classified as IDAR. This implication of the same will typically widen the tax net, first of all, and secondly, maybe put to rest many of the controversies also which are currently going on. POS to be the destination of goods in case of export through mail courier. So we were witnessing a problem in these kind of cases. Why this amendment was brought in, I would give you a brief history of that. So if there is a service provider for the I am here the supplier of goods, manufacturer of goods, and I need to export my goods, and I hire a person, the freight forwarder in India only, who exports the goods for me. So in that case, he raises an invoice on me, wherein he charges an IGST, because the place of supply provisions required him to charge an IGST on me, wherein it stated that the place of supply in case of transportation of goods was, if it is outside India, then in that case, the place of supply is outside India. So in such a situation, IGST was being charged to me, because definitely it was not export of service from for him, because the recipient, I am also located in India, plus he is also not getting any forex. So it was a taxable service on which he was charging IGST to me, but I was not being able to take even though there is no bar, but I was not being able to take the credit of the same due to the portal issues, because the same were being shown as the services in other territory, and the portal allowed me to take the credit of those services, typically for which the place of supply is my destination only. So due to these kind of problems, we were facing that there were so many queries being raised whether in such cases the credit would be allowed or not, and there were mismatches being shown in the system. So therefore now this problem is resolved, and now this particular condition of transportation of goods outside India, if it is there, then the place of destination would be outside India. This particular provision itself is removed. So if the registered person is providing the services to a registered person for the transportation of goods, meaning thereby that both the parties are here in India, then in that case, the place of supply would be the place of the recipient, and accordingly, there will be no problem on the portal and no problem in GST or 2B for me to take the credit also. Now we will move on to the income tax section. We will take up the FAQ section towards the last, after the income tax section, and whatever your queries are, we will try to answer to the best of our efforts and according to the time availability. So I hand over the platform to Dipanshu Gupta, who is the Managing Director of DGA Global, an associates firm, and this is our associate firm. So now I hand over the platform to him.
Thank you so much, Shweta. Good evening, everyone. My name is Dipanshu, and today I'm going to discuss about the budget changes which have come up in the Union Budget 2023. Let us just look through some of the changes which have come up in the personal taxation regime. As per the new tax regime, which was prescribed under Section 115 BAC, the tax rates have been changed a bit. Instead of 6 different slabs, now there are 5 slabs. The slab for 25% tax rate has been removed, while the brackets have been increased from 2.5 lakhs to 3 lakhs for each bracket. So this way, there will continue to be a highest tax of 30% for the income earned above 15 lakhs, while there has been some rezig between the slabs from 0 to 15 lakhs. Within this new tax slab, in order to promote the new tax system, what has been done is this is being made mandatory in the sense that the option, there is not an option to go into Section 115 BAC, but it will be a default scheme of arrangement wherein both all like individuals, HUF who already were there in this scheme earlier, now even AOP, BOIs and AJPs have also been included in the scheme. So eventually, if you want to go back to the older regime, you will have to make an option. Otherwise, by default, you will be in the new tax regime. Just to promote the new tax regime, there are a few changes which have been made in the new tax regime, which are the first one is the standard deduction under Section 16 of 50,000 rupees has been allowed to be taken as a deduction under the new section, which was not the case before. Donation made to the Agniveer Corpus Fund has also been included as part of the deductions under Section 115 BAC. And similarly, the family pension which one receives under Section 57(2)A is also being included as a deduction. Apart from this, there are 2-3 other deductions which were there in Section 115 BAC even before. One of them was investment in the pension funds, and the other one is additional deductions in respect of additional employees over a period of time. So all those things have been done in just to promote Section 115 BAC. Last but not the least, the rebate under Section 87A, which was 5 lakhs up till last year, especially for Section 115 BAC, which is the new tax regime. The rebate has been increased to 25,000 rupees, which means any individual who earns an income up to 7 lakh rupees, if he is opting under the new tax regime, he will not have to pay anything, even without any investment or anything. Like if someone is earning 7 lakh rupees or so, then eventually he will not have to pay any tax in India, and there is no further obligation on him to make any further investment or anywhere. Especially when we talk of the beneficial provisions between the older regime versus the new regime, I believe there will still be a scenario wherein professionals may feel that the assessee is more beneficial in the older scheme versus the new scheme. It depends on the perspective, and it depends on what all investments and what all expenses the person incurs. Since now this new scheme is being applicable to AOP and BOIs as well, probably that is one reason which can be done. If we really look at the continuity from the last year, there is one important change which has been made, wherein the maximum surcharge rate of 37% has been reduced to 25%. Again, I just want to reiterate that this is being done to promote Section 115 BAC, which is the new tax regime. If you actually have to opt for the older regime, you will continue to pay surcharge at 37% and not on 25%. By doing this, under the new regime, the highest tax rate will be 39%, as against 42.74%, which was there in the older regime. Moving on to the next one. This is a very important amendment which has been done to basically ensure that the HNIs eventually end up paying like more tax, if I say so, because so far all the life insurance policies which any assessee buys, at the end of the term, the withdrawal which is being received, or like the redemption which happens, on the redemption there was always no tax to be paid by the assessee. However, this time, very categorically, if there is any life insurance policy other than ULIPs, wherein the premium paid is more than rupees 5 lakh in a year, then in that case, at the end of the maturity of the policy, whatever amount is being withdrawn, it will be taxed as other income. As part of this, the calculation is made in a manner wherein the withdrawal amount will be treated as the income, while the investment which has been done over a period of time will be treated as the will be treated as an allowable expense. So apparently there is nothing like an indexation or something which is going on inside. And this is a bit stringent in the sense that wherein any premium which, like in any year, if the premium increases beyond 5 lakh rupees, then these provisions will be attracted within the entire life cycle of the policy. The one important thing to note is that this will be applicable on the new insurance policies, which will be issued after 1st of April 2023. So I think that's one important change which has come up, especially for the taxation of HNIs who otherwise would have been misusing the benefit of this particular deduction, which was as per government otherwise available only to the low and middle income group profession assessees. Then for employees of non-government sector, the leave encashment exemption has been increased to rupees 25 lakhs. It was earlier rupees 3 lakhs. So whatever leave encashment which a person receives on retirement up to 25 lakhs is exempt from tax. The next important change which has come up in case of a presumptive taxation scheme is there were 3 different sections which pretty much relates to individuals and HUF individual partnership firms and HUF who could apply 44AD and 44ADA depending on if they are business or specified professions. Within this, under section 44AD, there was earlier a limit of rupees 2 crores, which has been increased to 3 crores. However, with this increase, there is an added stipulation which has been brought in place, which is that for those assessees, the income should not include any cash receipts more than 5% of their total income. This basically is done to ensure that assessee does not bring any of his cash income into 44AD and then eventually take the benefit of 8 or 10 or like 6 or 8%, whatever rate, depending on if these are online or offline receipts, and then turn his income like into white also, if I say so. And then for under section 44ADA, which typically applies to the specified professionals, the limit was 50 lakhs, which has been increased to 75 lakhs now. Here again, the cap of 5% cash receipts is being applied. Also, it is important to note that it's been 2 years when the tax audit limit has been increased from 2 crores for businesses to 5 crore and then eventually to 10 crores. And along with that, at that time also, the applicability of TDS for these professionals or for these businesses was not changed. However, now also, like, even though this limit has increased in the sense that there is no requirement to maintain books of accounts or there is no requirement to audit if you are reporting a certain percentage of your revenue as a profit, applicability of TDS will still remain there. So if you are an assessee if you're a professional who is earning 60 lakh rupees as his revenue for the year, you may not be required to maintain your books of accounts. You may not be required to maintain your to have an audit done, but eventually you still be required to deduct TDS, for the payments which you make. So I believe like that is one change which may come up in near future to align these sections together. Next one is relating to the different deductions which an assessee gets under his business or profession. The most important change which has come up under section 43B is in relation to the payments which have been made to MSMEs. Now, this is a very important change which has come up, wherein in order to ensure that the payments to MSME sector are being made on a timely basis, We know that there are separate sections which are there in MSME Act and also in Companies Act to ensure that there is proper disclosure along with interest and there is necessary reporting under Form MSME 1 in Companies Act. However, I think this one change, which is we all know that Section 43B relates to certain expenses which are allowed only on payment basis. So any payment which is to be made to MSMEs, that expense will be allowed to the SSC only when it has been actually paid. And the way the section is interpreted, it is said that if it is paid within the time limit allowed under MSME Act, then in that case, it will be allowed on accrual basis. While if it is not paid within the time limit as per MSME Act, then in that case, it will be allowed on actual payment basis only. Let me just give you an example of this. So just to interpret how this section will affect pretty much every business out here, both the MSMEs who certainly are going to get the money quicker, but also a lot of compliance to those entities who deal with who deal with their vendors as MSMEs, which is what will happen is if you are actually making any payment. So MSME Act typically says that you have to make payment within 45 days. If there is an agreement, and as per the agreement, you have to make within 45 days. Along with that, if there is no agreement, then the Act prescribes a time period of 15 days. So if there is any payment being made during the year for which you have booked an expense, but payment is not being done within 15 days or 45 days, then in that case, you will be allowed this expense only when you make the payment. Just to give you an example, if the expense is recorded on 25th of March 2023 now, this year, and this is applicable from next year. So let's take 25th of March 2024. If the payment is being made and the credit period is 45 days, say so. So if the payment is being made by 10th of May, then the expense will be allowed in the year 23-24 only, which is the financial year in which the expense is recorded. While if the payment is not made by 10th of May and is made, say, on 15th of May, then in that case, the expense will be allowed in the subsequent year, which is financial year 24-25. So I believe apart from all the other closing and reporting requirements, the companies now will have to ensure that they are making the payments to MSMEs, especially near the end of the year, in time, so that they can be allowed this expense on booking itself and not on the payment basis. I mean, that's just one compliance thing which is being made more stringent to the companies now. Moving on to the next one. In terms of the preliminary expenditure which any SSC can allow as a deduction under Section 35, earlier there was a requirement to have a feasibility report which can be prepared only by SSC himself or by a person authorized by the board. Now this provision of authorized by the board has been removed, and therefore these deductions can be claimed only on the basis of submission of details in the prescribed format. We believe that there will be a separate format which will also come up for this purpose. And the next one relates to the distributions by business trusts to its unit holders. So it has been seen that the business trust, which is investment IT like InvITs and REITs, they when they distribute to the event, so basically they are the tax exempt entities wherein they are pass-through entities, and eventually the income is taxed in the hands of the unit holders, be it the case of interest or dividend income or rental income. So any other payment which is being made to these unit holders, that will not be charged to that will be charged to tax as other income if it is not in the nature of any of these three. What has been happening, we have seen, is that repayments are being done by the trust to the unit holders, which is otherwise not covered, and therefore eventually none of these entities, neither the business trust nor the unit holders, eventually pay tax on it. But that is not the intention. So now this will be taxed as other income in the hands of unit holders, and as such, on those distributions, business trust will continue to not pay any tax. It will be a tax on the unit holders. Moving on to the next one, which relates to the two important changes which have happened in the startup domain. So one is that the startup Section 80 IAC started in 2016. It began from 1st April 2016, and any entities who would be registered as a startup till 31st March 2023 were allowed to take the benefit of tax exemption for 3 consecutive years out of 10 years of 100% of their profit. Now this is being further extended by 1 year, which is now these startups can be incorporated till before 1st April 2024. The second one relates to the set off of and carry forward of losses for these startups only, wherein there was a requirement wherein there was a requirement to ensure that in the year in which the loss is incurred and eventually it is carried forward, there is a requirement that the 51% of the shareholding of the company should remain same till the year the expense is actually set off as against the income earned in that particular assessment year. So now this limit was there for 7 years, while in line with the 10 years of proposed benefit to these startups, this loss carry forward is also allowed to be extended till 10 years. So that is one change which has come up, which will actually align the benefit which these startups receive over a period of 10 years. Of course, this will happen. Of course, it is important to ensure that all the other conditions which are applicable for a startup to be eligible, to be registered as an eligible startup remains same. There is no change in those conditions. The next one is regarding the clarity which is being provided on the perquisites or the benefits which are paid in cash. It is said that now all these perquisites which will be paid in cash will be exclusively covered under as income within PGPP under Section 28, and also with respect to the TDS on these perquisites or benefits which are paid in cash under Section 194R, it is exclusively mentioned that they, perquisites received in cash will also be included. There was a Supreme Court judgment which actually led to the scenario wherein the Supreme Court mentioned that any perquisite received in cash, TDS should not be applied on it, and that was never the intention of the lawmakers, and that is the reason why they have exclusively included TDS on under Section 194R on these perquisites which are paid in cash and not just in kind. Another important change which has come up is in terms of the time limits for bringing consideration against the export proceeds into India, which basically applies to SEZ. And under Section 10AA, this benefit will not be extended if the export proceeds are not brought into India within 6 months or the time allowed by competent authority. So if there is any SEZ who has exported and those export proceeds have not come into India, the benefit of Section 10AA will not be available to them unless they otherwise would go to RBI and look for an extension of time. Another important change which has come up in case of cooperative societies is in a similar manner, the way the companies have been provided with the benefit of a Section 115BAB, wherein a lower tax rate of 15% was applicable to them. The same benefit is being passed over to the manufacturing cooperative societies now. So any cooperative society which is established after 1st April 2023 and which starts its production before 31st March 2024 will be allowed to have a concessional tax rate of 15%. And of course, all the other conditions are same as far as 15BAB is concerned. In this case, surcharge will also be at 10% and not a higher. There are tremendous changes which have come up in the charitable institutions again. We will pretty much not be covering them because of the time, which we do not have a lot right now. I'll move on to the capital gains taxation now. There are certain important changes which have come up here. The first one is regarding Section 54 and 54F. Both of these sections pertains to the benefits which the assessee gets after selling the property and investing the proceeds which have been received from sale of the property into the other assets. However, a very important change which has come up here, which is that the benefit is being restricted to 10 crores only. What it means is that if there is any HNI who has sold a property worth, say, 20 crores, and then he could have got the entire benefit of not paying the long-term capital gain or short-term capital gain as such, for under section 54 or 54F, rather only long-term capital gain. So he will not be able to take this benefit beyond 10 CRs. So eventually, in this case, he will have to pay out any amount which is higher than 10 CR, which he would have invested in. This is a similar, since both section 54 and 54F also allows a provision of capital gains account scheme, wherein if even the house property is not purchased within 2 to 3 years of the sale of the original asset, even then he can invest in capital gains account scheme. Even that amount is being restricted to 10 crores. So this eventually will be a situation wherein any property, if you are selling, you will have to shell out capital gains tax if the property's value is more than 10 CR. The next one is regarding the capital gains on the market-linked debentures. Market-linked debentures have been so these are the debentures which have any underlying principal component in the form of debt security, while their returns are linked with the market. So a very important change which has come up is for any of these market-linked debentures, the capital gain will be treated as short-term capital gain, and therefore a higher tax rate will apply. And the benefit of long-term capital gain cannot be taken by the assessee in such a scenario. So this is a new section which has come up, section 50AA. Under section 48, there is an important change which has come up for the assessees who take home loan, or the assessees, and after taking home loan, they actually take the benefit of interest payment under section 24 under income from house property, or they take chapter 6A deduction as part of a deduction on their total income. So this is one provision which has been tested in the eyes of law, and there have been several judicial pronouncements wherein an assessee was allowed to take double benefit of interest payment, one at the time of one under section 24, and second at the time of selling of that property, he could actually take the interest paid on the loan as as an expense for the calculation of capital gain. So now it has been explicitly included under section 48 that if there is any property which is being sold, at that time, if the interest or principal thereon has been taken as a deduction under section 24, or a deduction of or a deduction under section under chapter 6A 80C on account of the repayment of home loan, then that interest will not be included in the computation of capital gains. So this will lead to a higher capital gains, be it short term or long term, for the assessee. Or so basically, it eventually will end into a situation wherein the assessee has to really evaluate if he wants to take the benefit under section 24, or he wants to take the benefit, at the time of selling of that house property. Section 55, which talks of the cost of acquisition or improvement for intangible asset, it has explicitly mentioned that any intangible asset or any other right for which no consideration has been paid, then in that case, the cost of acquisition or cost of improvement will be considered as nil. So then in that case, eventually, if there is any sale of intangible assets or any other right, then the entire sale consideration will be will be taken for the calculation of capital gain without any cost of acquisition or cost of improvement, which otherwise could have been the case before. Under the joint development agreement, the full value of consideration has to be taken as stamp duty value along with the cash payment. So basically, this is just a This is a change. This is an amendment which is made to clarify to clarify the perspective which has come up over a period of time. Basically, what has happened is that Section 45(5) mentions that full value of consideration for the calculation of capital gain was the sum of stamp duty and the cash receipt and the consideration received in cash. Now, what has happened is that the industry-wide, it is assumed that it would mean that any consideration which is received in check or draft, that will not be included under the full value of consideration. Ideally, it was always not the case. Like it was always that it should have been included. Now, this provision has been rationalized and explicitly it is mentioned that any consideration which is received in check will also be included in the computation of full value of consideration. Now I move on to the changes which have come up in relation to TDS. So there have been several things which have come up. Like the first and one of the important one is regarding the TDS on net winnings on online games and offline games. So basically, winning from lottery was always included under the provisions of income tax. Now, explicitly, a section has been incorporated for winning on online games. And in case of winning on online games, a TDS at the rate of 30% of net winnings will be deducted at the end of financial year. Now, these winnings could be in, these winnings could be in cash or in kind. So both of the kind of winnings will also be included for the purpose of computation of TDS. It is important to note that this will not be at the time of like this TDS will not be deducted at the time of transfer of amount into your profile or into your account, like not your bank account, but into your profile. But it will be taxed only at the end of the financial year, which will be taxed at 30%. Yes, if you actually withdraw that amount during the year, then in that case, income tax will be deducted at the time of such withdrawal. And not just this, if there is any situation wherein there is part cash and there is part kind winning, then in that case, if the cash part is not sufficient to cover the taxes of in-kind winnings, then it is the responsibility of the person paying the winnings to make sure that the assessee eventually pays up that cash portion to him, to the person who is responsible for paying the winning, and only then he will be disbursing the cash portion out. So there is a particular calculation which has been given for how net winning has to be computed, and that has to be considered into account, including the fact that gambling or other betting is included under 192B. The next important change in TCS provisions has come up wherein for any foreign remittance which is made under liberalized remittance scheme, which is LRS, it's been a few years when TCS has been applied on foreign remittance through LRS. Initially, it was 0.5% for education loan transfers, and 5% for medical transfers and other education and other transfer related to education, up to a maximum of ₹7 lakhs. While now, these two limits remain same, but the limits relating to the other two categories, which is your overseas tour packages, which was 5% without any threshold. Now this has been increased to 20% without any threshold. So typically this would mean that if you are going to Europe, Thailand, Australia, anywhere out of India, you will have to shell out 20% extra, because there will be a TCS which you will have to pay apart from the expense which otherwise you would incur on the foreign trips. Eventually, this 20% could then later be taken back, or maybe the benefit of this could be taken back at the time of filing return. But certainly this is a big amount of funds which is being blocked because of this. Probably this has been done to ensure that people who are going to foreign countries eventually file their tax returns, because maybe like 5%, a person who otherwise doesn't file his return may not really would like to file his return. But then now with 20% TCS, he will certainly be prompted to ensure that he file the return and declare his income properly. Of course, it is implied that if someone is going for foreign trips, he certainly would have income enough to, have that kind of luxury. The next biggest change which has come up, apart from the overseas tours, is in any other case, which is other than the three scenarios: one, medical; second, education; and third is overseas tours. Apart from all these three, if there is any other payment which is being made, or through foreign remittance under LRS, then eventually, earlier there was a restriction of 5% TDS on the amount which was above 7 lakh rupees. Now it is 20% TCS without any restriction. So this is going to be a major change, and this is coming effective from 1st of July 2023. The next relates to the TDS on payment of interest on listed debentures. So far there is so far there is no so far there was an exemption on payment of interest on listed debentures without any minimum threshold, while now TDS will be deducted at the rate of 10%. There is no minimum threshold in this situation, and this has been the exemption which was earlier provided under Section 193 has been withdrawn. The next, I think this is one very interesting change which has happened, which I believe like should have happened much before, which is we have seen that the hard provisions, or like the tough provisions of Section 206AB and 206CCA, which deals with the higher rate of TDS or TCS, which is applied on the assessees who are not filing their income tax return. They have been made applicable since a few years. However, we several times see that apart from the fact that it impacts those assessees who were avoiding to file the return, at times it also impacts the assessees who were not even required to file the return. So if there is someone whose income is below threshold, or there are foreign entities who do not have any PE in India, they they were under the dilemma wherein they either will have to obtain PAN in India to ensure that higher TDS rates provisions are not applicable to them, and they were actually pretty high, as high as 20%. So now this provision is going to be beneficial for those who were really not required to file their return in India. I think this is a welcome step which has been drafted now, and I believe it should have been drafted much before. The next relates to the TDS on payment of accumulated balances due to an employee. So far, if there is an employee who who is receiving any lump sum payment on account of his EPF, with to whom TDS was deducted at the highest rate under Section 192B, while now it has been proposed that in such a situation TDS will not be deducted beyond 20%. If there is someone who has low income and therefore he might not have his PAN in hand, therefore for him the TDS will not be at MMR but will be only at 20% rate. I think this is one provision which could further be reduced down, because if there is someone who through his life would not have since this relates to employer-employee relationship, there are always other mechanisms wherein there is a responsibility casted on the employer to ensure that he deduct the TDS on as per the prescribed applicable rates for the employees during the year itself. Probably here if the employee does not have a PAN, then in that case, like there is even no requirement to deduct a higher tax rate of 20%, because at the end of it, it is the employer who has this obligation to make sure that he deduct appropriate TDS for the employee. I think with 20% tax being deducted now, probably it will still be a push for the employee to ensure that they take the PAN. The next relates to the facility of TDS credit for the income which was already disclosed in the return of the last year. I think this is an important change which has come up, because what has happened is that it's a pretty clear-cut situation wherein, because of accrual situation, an income is being recorded in a particular year, while the TDS credit is being received in a subsequent year. Like always, there are issues wherein the income is being taxed in 1 year, and then the assessee actually pays tax on it, while in the subsequent year he is getting the credit. So I think this is a welcome change which has come up, wherein it is facilitated that they can take the credit, and they can then report or show where this income was reported in the previous year. Another important change which has come up in case of TDS defaults is there was no explicit provision which provides for the penalty for non-deduction of TDS on several transactions, including 194R for benefit and perquisites, 194S for virtual digital assets, and also for 194BA, which is tax on net winnings from the online games. So now it has been explicitly included within section 271C and 276B, providing the provisions for penalty and prosecution in case the payer does not deduct TDS under these respective sections at the time of making payment. So the next is regarding the non-residents, and there are certain changes which have happened, which are like, I think, typically to ensure that the certain incomes which have been missed are being included under the tax regime. The first one relates to the tax. The first one relates to the gifts which have been given to the non-resident Indians. So there is always a deeming provision when a gift is being made to a non-resident, while any gift which is being given to a non-resident Indian, that was never covered under the deeming provision, which has been brought into covers now. So effectively, if you are paying an amount exceeding rupees 50,000, like a resident is giving an amount exceeding rupees 50,000 to a non-resident without any consideration, then in that case, for the not ordinary resident, it will be treated as it is the income deemed to accrue or arise in India, and therefore he will have to pay tax on this income in India only. The other provision relates to the benefit of DTA on paying NRIs or foreign business money obtained from mutual funds. TDS is to be deducted on 20% or less in accordance with DTA. So basically, this DTA benefit is being extended to section 196A, wherein if the mutual funds are being distributing money to the non-resident to NRIs, then the beneficial provision of DTA could be applied instead of just simply looking at the TDS at 20%. So the lower of the two will prevail, which is always the condition for several other payments being received by non-resident Indians, while not for the money received from mutual fund. The third relates to another important change which has come up to bring non-residents at parity with the residents. So if there is any non-resident who is procuring the shares of an Indian entity, then if they are purchasing the shares at a value which exceeds the shares face value, then in that case they will have to do the calculation basis the shares market value, and the difference will be treated as other income in the hands of those in the hand of the non-resident. So basically, this brings parity between the residents who are purchasing the shares of a company and the non-residents who are purchasing the share of a company. I think this is to just bring both of these kind of assessees at par. The next relates to unabsorbed depreciation and brought forward losses of section 44BB and 44BBB, which relates to non-residents to whom the presumptive taxation provision applies. For IFSCs, which is at the gift city, there are 2-3 important changes which have come up. One is that in order to promote the SPVs to shift to the gift city, the time limit for relocation has been extended from 31st March 2023 to 31st March 2025. This will mean that under section 47, this will not be treated as transfer of assets. And the second one relates to section 10(4)(e), wherein it is provided that the income which is distributed on the offshore derivative instruments, in that case, there will be an exemption to these incomes. So that's a welcome step under section 80LA 1A, read with section 10(4)(e). There are certain other proposals which have come up. One relates to the exemption which was earlier provided to the news agencies in terms of tax, in terms of applicability of income tax. Now, this exemption has been removed. So all the news agencies will have to pay tax if they are in the business of collection and distribution of news. And, this exemption is withdrawn now. The other one relates to clarification which has been provided in terms of advance tax while filing updated return. So what used to happen is that when updated return is being filed, the higher tax provisions were applicable, and it was not very clear as to if the interest has to be paid on the total amount of tax which is calculated now in the updated return, or the benefit of tax which has already been paid should be given while calculation of income tax. So it's appropriate clarification which has come up, wherein it is obviously appropriate that the amount which is already being paid should not be applied on that amount, and that is being clarified. Relief has been given to the sugar cooperative societies from certain past demands with respect to the payments which they make over and above the minimum price which is being set by the government. So that is going to, close several of the litigations which have come up over a period of time since 2016 or so, when this provision was first brought in. So under section 194N, one very quick update relating to the payments being made by the banks to the cooperative societies. Since most of these cooperative societies, the cooperative NBFCs work at a ground level, for them, the threshold of 1 CR has been increased to 3 CR. So eventually, they will not have to pay. TDS at 5% or 2% up to rupees 3 CR as against 1 CR, which was the case earlier. In order to promote e-gold or electronic gold receipt, government has specifically mentioned under section 45 that any conversion from gold to electronic gold receipt will not be treated as transfers. Therefore, as such, there will be no capital gain at the time of transfer. And of course, the relevant provisions related to how the cost of acquisition will be treated have also been redefined to ensure that the entire period is being included, both the physical gold and the period in which the electronic gold receipt were held, up to the actual date of transfer of either the gold or electronic gold to the other SSC. Certain strategic divestments have been facilitated by way of amending the definition of strategic disinvestments. Now this definition is clear in terms of providing the fact that the government's holding should reduce below 51%, and also the transfer of control is being made by the government to the other, to the next amalgamated entity. So this is a welcome step, along with the fact that the carry forward of accumulated loss or unabsorbed depreciation in such a case will be carried forward, will be done up to 5 years of strategic investment. Certain other changes which have come up in the field of tax administration, I'll just cover them briefly due to the paucity of time. The first and the most important change is an introduction of joint commissioner appeals as a appellate authority, in the sense that once an order is being passed by the assessing officer, instead of directly going to commissioner of instead of going to CIT appeals, there is this one level of joint commissioner appeal which has been incorporated. Though the provision is being made and it is pretty much akin to the CIT appeals, however, it is certainly not very clear here if this should be faceless or it will be physical joint commissioner appeals. We are hopeful that it should all be faceless, given the spirit of Income Tax Act and how the appeals and assessments are being done now. But I think that is one thing where the budget is silent right now. Another one is regarding the transfer pricing reports, which have to be submitted by the assessees to the assessing officer under Section 92D. So far, once your file is being picked up by the assessing officer for detailed scrutiny, you will have 30-day time to submit the TP report and the TP study. Now, this time of 30-day has been reduced to 10-day. I think the pretty much intention is that if the return has been filed, if the income tax return has been filed along with the transfer pricing report, the assessee should always have all the necessary supports with him, including the transfer pricing assessment. So I think it is important to ensure that assessees on whom the transfer pricing regulations are applicable, they are ready with their transfer pricing study as well as the transfer pricing report right at the time of filing of return, because otherwise, if a notice has been received, it will be very less time for the assessee to collate all that information. It's just 10 days time. Even this 10 days time could actually be extended up to a maximum of 30 days. So earlier it was a time of 30 plus 30, while now it is 10 plus 20, a total of 30 days time, which is being provided. So that's one. Another change is relating to the disposal of pending rectification applications. So we know that the rectification applications which were expiring on or after 1st of February 2021, but before 1st of February 2022. For all of them, the period of amending an order or making an application has been extended by like 6 more months from to 30th September 2019. Few more changes which have happened with regard to the assessment timelines from an department's perspective, not for the assessee as such, which is the 12-month from the end of the assessment year are being allotted for the completion of assessment beginning 1st April 2022. And further, this time could be increased by the period of 12 months. These have been, this will also impact search and seizure cases under Section 132 and 132A. Under Section 153, there are a certain set of orders which were against which an appeal can be filed before appellate tribunal. Within these orders, there are at the time of filing an appeal against these orders, the provision of memorandum of cross objection has been made available now. So it is a welcome move from a perspective of faceless assessment, which is taking place nowadays. Another one very important change which has come up is in relation to the inventory valuation. Now, the income tax officer, now the income, not the income tax officers, but the assessing officer has the power to direct the assessee to get the inventories valued by the cost accountants. These cost accountants are the ones who are nominated by CIT, PCIT, and Commissioner, Chief Commissioners. So now the assessing officer has the power that he can get your inventory valued, and this valuation will be done by the cost accountant, which are nominated by the department, and all these expenses will be paid by the central government only. All these expenses include now one of the important thing is this will eventually lead to a situation wherein the assessees who just report inventory to ensure that their profit is reduced to a certain extent of their comfort. For them, it is a very important change which has come up, wherein the assessing officer has been given power to ensure and evaluate the valuation of the inventory which was available as at the end of the year. Certain changes have been made in case of business restructuring, wherein after an order of High Court or after an order of tribunal, within 6 months' time has been given for the assessee to file the revised return. This is just a welcome change which has come up, though practically we have seen that some of these changes have always been provided by the courts of India. I think that's all from my end. I'll move this back to Shweta, and then we will be opening up for questions if by anyone. Shweta, over to you.
Yeah, please stop sharing your screen, Dipanshu. So now we are opening up the session for the FAQs, and just a second. I have allowed the participants to unmute themselves. So if anyone has any questions, then in that case, they can unmute themselves and accordingly ask the questions.
Yeah, Ramaswamy here from Nash.
Yes, sir.
Yeah, see, the thing is now the budget has said that within 3 years, the returns can be filed.
Yes, sir.
Okay, what happens to the credit?
So for that, they haven't made any clarity, and we are quite hopeful even for this 3-year period thing, they will bring out with some clarification with respect to how this is to be implemented, because as of now, there is nothing in this. As of now, it simply says that he can file not beyond 3 years. So as I mentioned in my session also, that even this is to be tested in courts as to how this will be interpreted, whether what period to be included, what period to be excluded. So there might be certain clarification or notification on this, which might even deal with the credits also.
See, the thing is now the GST 9 example. My supplier has not filed the returns. After 2 years, he files the return. I have already filed as a recipient. I have already filed my returns.
Correct.
I should be a provision to revise my GST 9.
Correct.
Because 2 years at the time when the 9 was